You're looking to understand VA loans, right? Especially the trickier parts, without getting totally lost in the weeds.
Yeah, you want the key info, the stuff that really matters.
Delivered in a way that actually sticks. That's what we're going to try and do here.
Today, we're diving deep into a really fascinating corner of the VA home loan program. We've got Chapter 7 of the VA Lender's Handbook right here.
Okay.
Specifically, that section on loans requiring special underwriting, guarantee, and other considerations.
Right. Think of this as your, insider's guide to the more unique VA loan situations.
Exactly. We've kind of done the heavy lifting, sifted through the jargon to bring you the crucial insights.
Yeah, some things might even surprise you, and we'll, keep it conversational. Our goal isn't to just drown you in rules.
No, definitely not. We want to give you a real feel for these specialized loans, how they work.
Our mission today, clarity. Bring clarity to these less common loan types.
We'll be exploring, everything from loans with multiple borrowers, joint loans, to the ins and outs of financing a new build.
Oh yeah, construction loans.
And even things like making energy-efficient upgrades.
Okay, sounds like a plan. Let's unpack this. We're going to look at joint loans, construction, and permanent home loans. Those energy-efficient mortgages you mentioned.
Yep. Alteration or repair loans, too.
Supplemental loans, adjustable rate mortgages, RMs, temporary interest buydowns.
Even farm residence loans. Manufactured homes classified as real estate.
Wow, okay. And finally, loans for Native American veterans on trust lands. It's definitely a packed agenda.
It is.
But let's just jump right in. Joint loans, what's the basic idea?
Okay, so at its heart, a VA joint loan involves a veteran and at least one other person. They share the responsibility for the loan, the liability, and they also share ownership of the property.
Right.
And the VA handbook actually breaks this down into several specific kinds of categories.
Okay, so we're talking situations like maybe a veteran buying with a non-veteran who isn't their spouse.
Yeah, exactly. Or maybe a vet buying with other veterans, but those other vets aren't using their VA loan benefits for this particular purchase. It also covers when a veteran and their veteran spouse both use their entitlement.
Okay.
And even a veteran teaming up with other vets who aren't spouses, where all of them are using their entitlement.
So the VA is really trying to cover a lot of different co-borrowing bases here, it seems.
It seems that way, yeah. And, it's just as important to understand what isn't considered a joint loan in this specific context.
Right.
Like a loan with a veteran and their non-veteran spouse, that's treated differently.
Okay.
Or even a veteran and their veteran spouse where only one of them is actually using their entitlement on this particular loan. Those aren't joint loans under these specific rules.
Gotcha. So joint loan is a very specific VA term for these certain multi-borrower setups. And was there something about fiancés?
Yes, good point. The handbook clarifies that. If a veteran and their fiancé are getting a loan and they plan to marry before the loan closes and hold the title as husband and wife, then the VA treats it like a regular spousal loan, not a joint loan. It's all about the intended marital status at closing, seems like. It's under Regulation 38 CFR 36.4307 if you want to look it up.
Okay. So when we hear joint loan in this chapter, it's basically a veteran using benefits plus at least one other person who isn't their spouse. Could be another vet not using benefits, could be a non-vet.
Precisely. And they even have a specific label, two veterans joint loan. That's for when two unmarried veterans both use their entitlement to buy together.
Right, okay. Now, the funding fee, that upfront cost, how does that work with these joint loans?
Good question. So the funding fees, they're basically calculated equally. They look at the number of people on the loan. The VA kind of considers each borrower responsible for their share when figuring out the fee. So like in a veteran loan, the fee calculation is based on just half the base loan amount, half the down payment, half the sales price to figure out the right charge for the veteran side.
Okay, split equally for the fee math. What about the guarantee? Does the VA guarantee the whole loan?
No, and this is like a really critical point. The VA only guarantees the veteran's portion of the total loan amount. The rest of it, the part tied to the non-veteran borrower. No VA guarantee on that part.
Okay, that's huge for lenders, I bet.
Absolutely. It's a risk factor they have to weigh. The VA is kind of balancing helping vets with, managing their own financial exposure.
Makes sense. And the occupancy requirement. Still the standard rule.
Totally. The veteran who is using their VA entitlement, they still have to certify they intend to personally live in the property, primary residence.
Okay.
That core requirement doesn't budge for joint loans.
What about the property itself, like the size or number of units? If multiple vets buy together, can they get a bigger place?
Yeah, this is where it gets kind of interesting. If the property is going to be owned by 2 or more eligible veterans, the rules actually allow for more units than a typical single vet purchase. You can have up to 4 family units plus 1 business unit.
Okay.
And then you can add 1 more family unit for each additional veteran who's part of the ownership group.
Whoa. So let's say 2 unmarried vets buy together, both using entitlement.
Yeah.
They could potentially get 6 family units and a business unit.
That's right. 6 family, 1 business. It's definitely more than 1 vet could usually swing with a VA loan.
But there's a limit, presumably.
Oh, absolutely. If the property goes over those limits, more than 4 units plus 1 for each vet owner, or more than 1 business unit, then nope, the loan's not eligible for a VA guarantee.
Okay. Got it. Now, when does a joint loan need prior approval from the VA? Does it always?
Not always, but any joint loan where the veteran is going to hold the title with someone other than their spouse, that needs to go to the VA for prior approval before closing.
Okay. Gives the VA a look.
Exactly. But if the title is just going to be held by a veteran and their veteran spouse, then the loan can usually be closed automatically. Doesn't matter if the spouse is also using entitlement or not for that specific loan.
Definitely simplifies things for married vet couples. Okay, let's switch to underwriting. How do lenders figure out the risk on these?
So the handbook lays out specifics based on the type of joint loan. For a 2-veteran joint loan, that's 2 unmarried vets, both using entitlement, lenders look at their combined credit, income, assets. The good news is 1 vet's financial strengths and income or assets can help offset the other's weaknesses there.
Okay, that helps.
And this is crucial, 1 vet's good credit cannot make up for the other vet having poor credit. Both need to be creditworthy.
Makes sense. Both got to be reliable. What about a veteran, non-veteran joint loan?
Different scenario. The veteran's credit have to be satisfactory, and their own income needs to cover their share of the loan payment, plus their other debt.
Their individual share.
Right. The non-veteran's credit also has to be satisfactory. Now, the lender can look at their combined income for the overall ability to repay the mortgage.
Why?
But the non-veteran's income can't be used to compensate if the veteran just can't afford their portion. The veteran has to stand on their own financially for their share. VA's focus is making sure the vet can handle their commitment.
Got it. The veteran's financial picture is still key. So how is the actual VA guarantee and the entitlement usage calculated for these non-vet loans? Sounds like steps are involved.
There are a few layers, yeah. The VA guarantee is limited just to the veteran's equal interest in the property.
Okay.
The funding fee percentage, that's figured out separately, Chapter 8 stuff. And lenders really need to double check that this limited VA guarantee is going to fly with their investors or the secondary market.
Because it's not the full backing.
Yeah.
And what are the actual steps? How do they figure out the guarantee amount and the entitlement hit?
Okay, there are basically 5 key steps. 1, take the total loan amount divided by the total number of borrowers. 2, multiply that result by the number of veteran borrowers using their entitlement, usually just 1 in a vet-non-vet case.
Right.
3, figure out the maximum potential guarantee the VA could offer on that specific veteran's portion of the loan.
Max potential.
4, the actual guarantee the VA gives is the lesser of that maximum potential amount, or are the total VA loan entitlement the vet actually has available.
Lesser of the 2.
5.
No.
The VA charges the veteran's available entitlement by the amount of guarantee that was actually provided. If you had multiple vets, you'd usually split that charge equally, unless they have a written agreement to do it differently.
That's a really clear breakdown. And the handbook has examples, right? Table 3.
Yes, Table 3 is super helpful. It shows how the math works with different loan amounts, different entitlement levels. You can see how it all connects: available, entitlement, loan size, the final guarantee, and the entitlement charge.
Okay.
Like one example shows a vet with $36K entitlement, $100K joint loan with a non-vet. The VA guarantee ends up being $22,500, and the entitlement charge is also $22,500.
And there's a quicker reference too.
Yeah.
Table 4.
Exactly. Table 4 is like a cheat sheet. 4 steps. Divide loan by borrowers. Multiply by vets using entitlement. Calculate max potential guarantee on that part using Chapter 3 tables. Then VA charges entitlement up to that amount.
Okay.
Divided equally if possible. And it notes if the vet's share is over $144K, there might be bonus entitlement involved.
What about the 2 veteran joint loan situation? two unmarried vets, both using entitlement. How's the guarantee and entitlement work there?
So for a two-veteran joint loan, the max potential guarantee calculation is based on the total loan amount, just like a regular single-vet VA loan.
Okay, so the whole loan amount drives the potential guarantee, and the procedure for the actual guarantee and charging entitlement.
Three main steps there. 1, calculate the maximum potential guarantee on the entire loan using Chapter 3 tables.
Okay.
2, VA guarantees the lesser of that maximum potential OR, the combined total available entitlement from both veterans.
Combined entitlement.
Right. And again, if the loan's over $144K, a bonus entitlement might kick in, ideally used for equal charges, but they can split it unequally with a written agreement.
Okay.
3, VA charges each vet's entitlement up to the max guarantee provided, or their total available if that's less. Split equally if possible. Unequal split needs that written agreement. Unless they're spouses, then VA follows their preference.
And Table 6 gives examples for these two vet loans.
Yep, Table 6 illustrates different scenarios, varying entitlement amounts for each vet, different loan sizes, shows the max guarantee, how much entitlement gets charged per vet, and it keeps emphasizing that written agreement needed for unequal use unless they're married vets.
Got it. Now, the certificate of commitment, the initial VA approval document, how does that look for a joint loan with a non-veteran?
Good question. For those vet-non-vet loans, the loan amount listed on the certificate of commitment, it only shows the veteran's portion of the loan.
Just the vet's share.
Right. And the guarantee percentage shown is based on the ratio of the vet's available entitlement compared to their share of the loan. And importantly, the certificate flat out states, no VA guarantee applies to the non-veteran's portion.
So the lender knows up front.
Exactly. It means if there's a foreclosure and a loss, the lender eats the loss tied specifically to the non-veteran's part of the debt.
And the final loan guarantee certificate, the LGC, after closing, same deal.
Pretty much. The amount of loan on the LGC will only show the veteran's portion or the total of all veterans' portions if multiple vets used entitlement.
But the mortgage docs show the full amount.
Correct. Full amount on the mortgage, but only the veteran's guaranteed share on the commitment and the LGC. Lenders need to be really sure their investors are okay with this setup.
This whole joint loan thing, could it cause issues with, like, fair lending laws, ECOA?
The handbook actually addresses that. It says a lender can refuse a vet-non-veteran joint loan application because of the limited VA guarantee, and that wouldn't violate the Equal Credit Opportunity Act.
Oh, okay. Why?
Because the VA loan program is considered a special purpose credit program under EQA rules, so that limitation is sort of baked in and accepted.
Okay. Last piece on joint loans. The funding fee calculation, how's that finalized?
Okay, you find the right funding fee percentage for the veteran depends on if it's their first VA loan, subsequent use, etc., using the tables in Chapter 8.
Right.
And you apply that percentage only to the portion of the loan allocated to a non-exempt veteran who's using their entitlement.
Only the vet's share gets the fee applied if they aren't exempt.
Exactly. And importantly, for this calculation, the total loan amount is considered split equally between all borrowers. Doesn't matter who actually put down more money or where the down payment came from.
Ah, that's a really key detail. The handbook even has an example, right, where the non-vet pays the whole down payment.
Yep, it clarifies that the allocation for fee calculation is still equal. And yeah, if you run into weird situations not covered, there's a VA number to call. 1-877-827-3702.
Good to know. Okay, let's move on. Big topic. Construction and permanent home loans. Sounds like a lot of specific rules here.
It is pretty detailed, yeah. But the VA can guarantee loans specifically for constructing a home that a veteran will own and live in.
Building from scratch.
Right. They allow for one-time close and two-time close construction loans. And later, these can often be refinanced using VA cash-out rules. But today, we're focused on the initial construction loans themselves.
Not the refis later on.
Correct. Not homes already built by a builder or later cash-outs. This is about funding the actual build for the vet. VA wants to help vets build their own homes.
And it's important up front. Once you pick a type one-time or two-time close, you're stuck with it after closing, right?
That's right. No switching tracks after the loan is finalized. And also, just for clarity, the VA considers both one-time and two-time close construction loans as purchase transactions.
Even if the vet already owned the land.
Even then.
Yeah.
For VA purposes, it's a purchase because a new dwelling is being created.
Okay, so let's define these clearly. What's a one-time close construction loan?
Okay, these are often called construction to permanent loans. It's one single closing that covers both the construction financing and the final permanent mortgage, all done at once.
Streamline.
Yeah. The permanent loan terms are set initially, but they get slightly modified once construction is totally done.
In a two-time close, how's that different?
Two-time close means two separate steps, two closings. First, the vet gets a temporary non-VA interim construction loan that closes before building starts, funds the build.
Okay, non-VA first.
Right. Then, once the house is finished, the vet applies for a separate VA guaranteed loan. This VA loan pays off or refinances that initial interim loan into a standard long-term mortgage.
Gotcha.
And just a note, things like HELOCs or loans that already have permanent financing built in, those don't count as the interim construction financing for this purpose. The first loan has to be specifically short-term for construction.
We mentioned cash-out refis briefly.
Yeah.
How do they fit in post-construction?
Well, a VA cash-out refi lets a vet refinance existing leagues and potentially take cash out up to 100% of the VO's reasonable value,
Right.
using a cash-out to pay off an interim construction loan. That is considered a net tangible benefit, which is usually needed for VA refis. But again, today we're focused on the loans that actually fund the construction.
Right. Who can actually build the house? Does the builder need special VA approval?
The vet can choose their own builder, totally up to them. But the builder must have a valid VA builder ID number before the VA issues the notice of value, the NOV, that's the VA appraisal, basically.
Unless
Unless the veteran decides to act as their own general contractor. If they're running the show themselves, no builder ID needed for them.
Okay. Where do you find info on builder IDs?
Chapter 10 of the handbook has more detail. And there's the website, the VA LGY Hub, where lenders can check a list of registered builders and find more info.
Good resource. What about the appraisal for these? Is it different from buying an existing house? When's it done? What does the appraiser need?
Yeah, it's definitely different. For one-time close loans, ideally the appraisal is ordered before the foundation is fully done.
Okay, early on.
Yeah. The appraisal request should say construction to permanent and status proposed. And it's critical the appraiser gets everything: blueprints, permits, detailed specs for all the materials.
Why?
So they can figure out the projected value of the finished home. Appraisers often wait to finalize their report until they have all those construction exhibits.
Makes sense. What about for two-time close loans? When's the appraisal usually done?
For two-time close, the VA actually prefers the appraisal is ordered only after the house is 100% complete.
Okay. Finished product.
Right. In that case, the request would say new construction.
Yeah.
But if it has to be ordered before it's done, it's handled like a one-time construction to permanent, proposed, and the appraiser still needs all the plans and specs.
And those later cash-out refis, if construction was done a while ago.
If construction's done, and at least a year has passed, usually shown by a certificate of occupancy or tax records, then it's just treated like a regular cash-out refi.
Okay.
Appraisal is ordered as VA cash-out refinance in WebLGY, no need for the original construction plans for the appraiser then. Focus is on current value.
What's the maximum loan amount for these construction deals?
For both one-time and two-time close construction loans, the max borrow amount is the lesser of two things: either the VA's reasonable value of the completed home or the total acquisition costs for the project, plus the funding fee, of course.
Lesser of value or cost.
And
cash out.
cash outs, as we said, can't exceed the VA's reasonable value. Chapter 3 has all the general max loan amount details.
Okay, let's break down acquisition costs. What counts for a one-time close?
For a one-time close, acquisition costs can include the actual contract to build the house, any money still owed on the land, an interest reserve account if set up separately to cover interest during construction, a contingency reserve for unexpected stuff, and permit costs if they aren't in the main contract. If the vet is their own contractor, then all documented labor and material costs count.
Receipts, contracts.
Exactly. But if the vet already owns the land, free and clear, the land cost or value isn't part of the acquisition cost for the construction loan itself.
Got it. And for two-time close, what are the acquisition costs then?
Simpler for two-time close, it's mainly the outstanding balance of that initial non-VA interim construction loan that's being refinanced.
Less land debt.
Plus any remaining balance still owed on the land, yeah.
Yeah.
But again, if the vet owns the land outright, its cost value isn't included in the acquisition costs for the VA refi loan.
When is the actual loan guarantee certificate, the LGC, get issued for construction loans, not right at the first closing.
Correct. While the loan's kind of conditionally guaranteed at closing, the actual LGC isn't issued until the VA gets a clean, satisfactory post-construction inspection report.
Final sign-off.
Exactly. Confirms it was built right, meets VA standards. All the conditions on the notice of value, including that final inspection, have to be met first.
But they still get the same level of VA guarantee as a regular purchase loan eventually.
Yes, absolutely. Once everything's done and checked off, the loan gets the same VA guarantee amount and percentage as a standard purchase loan. Chapter 3 covers those guarantee levels.
When's the funding fee due? And how is the loan reported during construction?
Funding fee is due within 15 days of the initial loan closing.
Regardless of construction progress.
Right. And importantly, if the VA guarantee somehow doesn't get issued later or the vet sells before it's done, no refund on that funding fee.
Ouch. Good to know.
And the loan has to be fully guaranteed in the VA's WebLGY system within 60 days after that clear post-construction inspection and meeting all the NOV requirements.
We talked about equity counting as a down payment for funding fees before. Does that work for construction loans too?
Yes, it does. For both one-time and two-time close loans, the veteran's equity can be treated as a down payment, potentially lowering the funding fee.
How's the equity calculated?
Depends when the land was bought. If within 1 year before the VA loan closes, it's the greater of the land cost or its current appraised value.
Okay.
If bought more than a year before, it's the appraised land value from the VA appraisal, if stated separately. If not stated, it's the vet's equity.
What if the land was a gift?
If gifted, only the vet's existing equity counts. But remember, this equity as down payment trick doesn't work for cash out refis.
Okay.
Chapter 8 has way more detail, and section in this chapter has good examples too.
What fees and charges can veterans actually pay on these construction loans? Different for one-time versus two-time.
Yes, the allowable fees are in Chapter 8, and they do differ. For one-time close loans, the lender might charge an increased flat fee if they're supervising construction and handling the draws. But on a one-time close, the vet cannot pay certain fees, things the builder would normally cover with an interim loan, like some inspection fees, title updates during the build, hazard insurance during construction.
Builder pays those on a one-time close.
Generally, yes. For two-time close loans, remember, the first loan is non-VA, so the fees for that interim loan are negotiated separately between the vet and that lender. VA isn't involved yet.
Right. Okay, let's get into the process weeds. Walk us through a typical one-time construction loan. Construction to permanent.
Sure. So one-time close, it closes before construction starts, handles both loans at once, funds get dispersed. Some might pay off land debt first.
Okay.
The rest goes into a construction escrow account, a draw account, or LIP account. Builder gets paid from this account in stages during construction.
With borrower approval.
Absolutely. Always needs the borrower's written okay for each draw. Lender has to keep records of those approvals. And because it's complex managing draws in progress, lenders doing these really need specialized experience.
Okay, so what are the typical steps? Soup to nuts.
Generally about 10 steps. 1, verify vet's eligibility. 2, order appraisal, construction to permanent, propose, provide all docs. 3, VA issues notice of value, NOV.
Right.
4, lender underwrites the whole thing. 5, loan closing disperse funds for land, if any, rest into escrow. 6, vet pays funding fee.
Okay.
7, construction happens. Lender releases funds from escrow per approved draws. 8, final inspection when nearly done. 9, loan terms might get slightly modified post-inspection for the permanent phase. 10, once all NOV requirements met, VA issues the final LGC.
Managing that escrow account and having a contingency reserve sound crucial for one-time close. How's that work?
Totally critical. The contingency amount is usually negotiated between the vet and builder upfront. The lender manages the escrow funds, releasing them based on verified progress and the borrower's sign-off.
What if there's money left over?
If funds remain after construction's done, it follows the contract. Might go back to the borrower up to what they paid up front, or it can be applied to reduce the loan's principal balance.
Does that affect the funding fee or guarantee?
Nope. Principal reduction at the end doesn't change the fee or guarantee amount, but the lender needs proof of that principal reduction.
When do the actual mortgage payments start for the vet on a one-time close? Not during construction, right?
Usually not. Payments typically start after construction is finished, but there's flexibility. The first P&I payment can be postponed up to a year from closing.
Okay.
And if construction takes longer than a year, it can be delayed further, month by month, for up to another 6 months if needed.
But the loan term
still has to fully amortize within the remaining term, max 30 years and 32 days total. VA wants roughly equal payments, annual principal reduction. They prefer avoiding big balloon payments at the end.
What if plans change during construction? Change orders. How are those handled?
Ideally, significant change orders get reviewed by the appraiser before the work is done to make sure value isn't lost.
Yeah.
If changes happen after the initial appraisal and they weren't included, those costs usually can't be added to the mortgage unless you had an updated appraisal reflecting the changes.
Who pays for that?
Could come from the contingency fund, or the borrower might have to cover it. Lender contacts VA's construction and valuation section via ServiceNow for guidance if needed, and keeps all change order docs.
Inspections are key. What are the VA's requirements for a one-time close?
Yep, gotta meet any inspection warranty requirements listed on the NOV. For proposed construction, there are options. Option 1, local authority does inspections, foundation, framing, final, and issues a certificate of occupancy, CO. VA usually accepts that. No framing check for manufactured modular, though.
Okay. Option 2.
If no CO, copies of the local inspection reports showing full compliance work, or written confirmation they were done satisfactorily.
And option 3.
If no local inspections happen, then you need a 10-year HUD-acceptable insured protection plan from the builder, plus a 1-year VA builder's warranty.
What about the final inspection?
When it's 100% done, lender calls the original VA appraiser for the final check. If unavailable, lender asks VA CMV via ServiceNow for another appraiser.
And that final check confirms
Confirms it meets VA minimum property requirements, MPRs, built per plans approved changes, and the value held up. Lender's job is to coordinate the inspection schedule with the contractor. Chapter 10 has more.
Can the interest rate float during construction on a one-time close?
It can. Lenders might offer a ceiling floor rate agreement that floats with the market rate during the build.
But with limits?
Yes, must have a maximum rate ceiling. Might have a minimum floor, usually lets the borrower lock in a rate later if they want. Lock agreements go in the file.
How's the borrower qualified?
Critically, they must qualify at the maximum rate in the agreement. Gotta ensure they can handle the worst case scenario.
What's the lender's role in managing the project itself? Just funding?
No, much more active. Lender is responsible for evaluating, monitoring, managing the whole project, making sure it follows plans, specs, contract, preserving the home's value. They're safeguarding their investment in the best.
Okay. And we mentioned fees the vet can't pay on one-time close. Any others?
Yeah, as we said, builder usually pays fees they'd incur on an interim loan. Certain inspection fees, title updates during construction, hazard insurance premiums during the build. Remember, two-time close is different for the interim loan fees.
Right. What if, worst case, construction isn't fully completed on a one-time close and not all funds are dispersed? How does the VA guarantee work then?
Yeah, tough situation. The VA guarantee only applies pro rata to the loan portion actually dispersed for construction and other costs.
How's that calculated?
You add up funds dispersed for construction plus other payments to the builder that capped at 80% of the completed construction value, then add funds dispersed for the land purchase.
Okay.
Lender has to certify land advances are lien protected and no other liens exist for completed paid work. If full completion isn't practical, lender contacts VA for guidance on getting a partial guarantee.
Got it. Okay, now the two-time construction loan process. How's this different again?
Key difference. Uses a VA loan to refinance a separate non-VA interim construction loan obtained first. That interim loan doesn't provide the permanent financing.
And VA prefers appraisal after completion.
Right, that's their preference.
So what are the steps for a two-time close?
Generally 9 steps. 1, verify vet eligibility. 2, vet closes on the non-VA interim construction loan. 3, construction happens, funded by that interim loan.
Okay.
4, once 100% complete, order VA appraisal new construction. 5, VA issues NOV based on that appraisal. 6, lender underwrites the VA refinance loan.
Right.
7, VA loan closes, after all NOV conditions met, pays off the interim loan. 8, vet pays funding fee on the new VA loan. 9, LGC is issued after VA loan closes.
What if a vet has construction complaints later about a home built this way? What can VA do?
VA's direct help is pretty limited, mostly focused on defects in equipment, materials, workmanship, reported during that first year, the period covered by the required 1-year VA builder's warranty.
Okay, and there's that comparison table, Table 7, right?
Yeah.
Puts it all side by side.
Yes, Table 7 is super useful. Compares one-time, two-time, and even cash-out refi features. Appraisal timing, VA purpose, purchase or refi, appraisal type, max loan, cash to vet, equity for funding fee reduction if refi NTB rules applied. Great reference.
And finally, section has even more examples on calculating purchase price and down payment for the funding fee system in various land ownership scenarios.
Yep. Tables 8, 9, 10, and Section U give very practical examples for lenders land bought recently, long ago, or gifted. Helps ensure correct reporting for the funding fee.
Okay, deep breath. Let's switch gears again. Energy efficient mortgages, or EEMs. What's the goal here?
VAEMs are designed to help veterans finance the cost of making energy efficiency improvements to their home.
Saving energy, saving money.
Exactly. These costs can be added onto a VA purchase loan when buying or onto a VA refi loan for a home the vet already owns.
What kind of improvements count?
The handbook lists a bunch. Solar heating cooling, better water heaters, insulation, walls, ceilings, floors, weather stripping, caulking, storm windows doors, high-efficiency furnaces, heat pumps, vapor barriers. Pretty broad list.
When a vet applies for a purchase or cash-out refi, do they find out about EMs?
Yes. As part of the notice of value process, they get a notice about potential energy improvements. Mentions energy audits, maybe from utility companies.
Okay.
And it specifically says the mortgage can be increased for things like solar, water heaters, insulation, weather stripping, storm windows doors, and suggests other energy stuff might be considered too.
How much can the loan actually increase for these EMs? Is there a cap?
Yes, specific limits. Up to $3,000 based just on documented costs of the improvements.
Okay.
Or up to $6,000 if the lender determines the resulting increase in the monthly mortgage payment, PITI, is less than the likely reduction in monthly utility costs.
So the savings have to outweigh the cost increase for amounts over $3K.
Basically, yeah. And
Sure.
VA does not allow EMs over $6,000 total increase. That's set by law.
How does underwriting work for EMs?
Depends on the amount. Up to $3,000, VA assumes utility savings will likely offset the slightly higher payment.
Makes sense.
But for $3,000 to $6,000 EMs, the lender has to do more homework. They must determine and document that the payment increase won't exceed the likely utility savings.
Based on what?
Reliable local info, utility company data, city or state energy agency estimates. Gotta document it.
Yeah.
Also, if an EM is added to an IRRL, interest rate reduction refinance loan, and the new payment jumps by 20% or more because of the EM, the lender has to certify the veteran qualifies for that higher payment.
What paperwork needs to go with the closed loan for an EEM?
Again, depends on cost. Up to $30K, just need proof of costs, bids, contracts itemizing the work.
Right.
$3K to $6K, need the cost proof, plus the lender's determination showing payment increase doesn't exceed utility savings.
And that IRRL scenario?
If the IRRL payment jumps 20% plus due to the EM, need the lender's certification that the borrower qualifies for the higher payment.
How do the VA guarantee and entitlement usage work with an EEM? Loan amount is higher, does entitlement charge go up too?
Okay, specific calculation here. Step 1, calculate guarantee on the base loan amount without the EEM cost.
Base loan guarantee.
Step 2, calculate guarantee on just the EEM portion using the same guarantee percentage as step 1.
Okay.
Step 3, total guarantee is step 1 plus step 2. Add them up. But, and this is key, the amount of veterans entitlement charge is based only on the original loan amount before the EEM was added.
Whoa. So entitlement charge doesn't increase due to the EEM.
Correct. Bigger guarantee overall, but no extra hit to entitlement. Table 8 in the handbook walks through this with examples.
That's a pretty good deal for the vet. How's the funding fee calculated? Original amount or increased amount?
Funding fee is based on the full loan amount, including the EEM costs.
Okay. Fee on the total. What if the EEM work isn't done before the loan closes? Can it still close?
Yes. Lender can set up an escrow account to hold back the funds needed for the improvements. Loan can still close.
Escrow holdback.
Right. VA doesn't have super formal rules for this escrow. Lender just needs to withhold the funds. Check Block 23 on VA Form 26/1820. No special escrow docs needed for VA reporting.
How long do they have to finish the work?
Generally expected within about 6 months. Lender notifies VA in writing when work's done and escrow is paid out. Gotta make sure funds were used right.
What if work doesn't get done?
If not done after reasonable time, lender applies the remaining escrow balance to reduce the loan principal and tells VA in writing. Chapter 9 has general escrow rules.
Can a vet ever get cash back from an IRRL specifically for EMs they already did?
Generally, IRRLs are no cash out, but there's one exception for EMs.
Which is?
Up to $6,000 from an IRRL can reimburse the vet for EMs they completed within 90 days before the IRRL date. Specific carve-out for recent energy upgrades.
Interesting. Okay, next up, loans for alteration and repairs. Sounds like for vets who already own.
That's mostly it. VA can guarantee loans just for alterations and repairs on a home a vet owns and occupies.
Or maybe with a purchase.
Or, yeah, done along with a purchase loan if the place needs work. Key thing. Repairs must be stuff ordinarily found on similar homes in the area. Basic livability, standard improvements.
And how does the value of these repairs factor in?
The cost can be included in a purchase or cash-out refi loan, but only if the property's appraised value after considering the completed repairs is high enough to support the total loan amount. Value has to be there.
Makes sense. Now, something called a supplemental loan. What's that?
Okay, a VA supplemental loan is specifically for alterations, improvements, or repairs on a property that already has a VA guaranteed loan on it.
Okay, existing VA loan needed.
Right. And the vet must own and occupy it or plan to reoccupy after major work. Purpose must be to substantially protect or improve basic livability or utility. Think maintenance, replacements, improvements, real property fixtures.
Not luxury items.
Generally not things like barbecue pits or pools.
Yeah.
And there's a limit. No more than 30% of the loan can go towards non-fixtures, like appliances related to the main work.
What about the LANGEN? Loan term limits.
Lender needs an effective loan. Can be done via an open-end provision in the existing loan, an amendment, a new lien covering both loans, or a separate junior loan.
Okay, term.
Max term is 30 years if it's fully amortizing. If non-amortizing, like a lump sum payment, max term is only 5 years.
Any other requirements for a supplemental loan?
Yeah, few more. The existing VA loan must be current payments, taxes, insurance, not in default.
No less.
Unless the supplemental loan itself will improve the vet's ability to repay the existing loan. Also, the supplemental loan can't increase the interest rate on the existing VA loan. If it needs a higher rate, it has to be on a totally separate note.
Does the vet always need prior VA approval for these?
Not always. Need prior approval if the lender doesn't have VA automatic closing authority, or if someone currently liable on the existing loan is going to be released from that liability. Otherwise, maybe automatic closing is possible.
What's the procedure for the lender?
They need a statement describing the work. Goes with the prior approval app or in the closing package if automatic. Need to report the outstanding balance of the existing VA loan too.
What about appraisals or inspections?
If the work costs over $3,500, need a notice of value, NOV, and VA compliance inspections.
Under $3,500.
If $3,500 or less, no NRV or VA inspections usually needed. Instead, need a statement of reasonable value from a VA-designated appraiser, nominated by lender, approved by VA.
Right.
Specifies work, costs, confirms cost doesn't exceed value.
And inspections for smaller jobs.
Lender usually submits their own certification of inspection by a qualified person in their org, confirming work matches the contract.
How do the guarantee and entitlement work for supplemental loans?
Depends. If the supplemental isn't consolidated with the existing loan, vet needs enough available entitlement for it. Gets a new LGC just for the supplemental.
It's consolidated?
If consolidated, VA issues a new modified guarantee certificate covering the total combined debt.
Okay, tricky scenario. What if the vet has NO available entitlement left, but the same lender holds the existing VA loan and is making the supplemental, and they're consolidating? How's the guarantee figured then?
Right, specific 5-step calculation for that exact case. 1. Take existing loan balance, multiply by its original guarantee percentage.
Okay.
2. Figure guarantee amount on the supplemental loan as if it were standalone.
5.
Since vet has 0 entitlement here, this amount will be 0.
Got it. 0.
3. Add existing loan balance plus the new supplemental loan amount. That's the new total debt. 4. Add the guarantee amount from step 1 on existing loan plus the guarantee from step 2, which is 0.
Yeah.
5. Divide the result of step 4 by the result of step 3, the total debt. That gives you the new percentage of VA guarantee on the combined consolidated loan. Allows financing even with used up entitlement.
Clever workaround. Okay, shifting in. Adjustable rate mortgages, ARMs.
Well,
what's the general VA setup?
VA ARMs have an initial fixed rate period, then the rate can adjust periodically based on market indexes. 2 main flavors. Hybrid RMs have longer fixed periods, 3, 5, 7, 10 years.
And traditional.
Traditional VA RMs usually adjust annually after just the first year. Give some initial payment certainty.
How much can the rates adjust? Are there caps?
Yes, crucial caps. Traditional ARMs 1 year adjust. Rate can only change plus minus 1% each year. Lifetime increase cap is 5% over the start rate.
Okay, 1% annual, 5% life. Hybrids.
Depends on the fixed period. If fixed less than 5 years, first adjustment is plus minus of 1%, lifetime cap is 5%. Same as traditional.
If fixed 5 years or more.
If fixed 5+ years, first adjustment can be bigger, plus minus at 2%, and lifetime cap is also higher, 6% over the start rate. How does underwriting work for VA RMs?
Yeah.
Anything special?
Yes. For ARMs adjusting after only 1 year, traditional, lenders must underwrite using an interest rate 1% higher than the initial rate offered.
Trust us.
Exactly. Ensures they can handle a potential quick increase. But for hybrid ARMs with a 3+ year fixed period, lenders can underwrite using the actual initial rate because there's that longer stability period.
Got it. Okay, now, loans involving temporary interest buydowns. Sounds like a way to lower initial payments.
Precisely. Buydown uses an upfront lump sum to temporarily cut the borrower's initial payments. Two main types. One is a marketing tool funded by builders, sellers, maybe the lender, makes the loan look more attractive upfront.
Okay.
Other type is funded by the borrower themselves, maybe as a financial strategy for lower payments early on. Important. Lenders can't secretly fund this by charging an above-market rate on the loan itself.
Can VA guarantee loans with buydowns?
Yes, if all other VA rules are met, but only works with fixed-rate loans. No buydowns on VA ARMs.
How does the escrow account for the buydown funds work? Rules.
Funds go into a separate, segregated escrow, legally protected, can only be used to supplement the regular note payments during the buydown period.
Can't cover late payments.
Nope. Or anything else. And if foreclosure or prepayment happens, any leftover escrow funds must be credited against the vet's debt. Can't go back to whoever funded it.
What if the loan is assumed?
Buydown escrow continues for the new borrower. Lender's job is to check the agreement, make sure it's legal, and give the vet a clear written explanation. Signed agreements kept in file.
What do these buydown schedules look like? How long? How do payments step up?
Minimum 1 year, maximum 3 years. Common ones are 3-2-1, 3% rate cut year 1, 2% year 2, 1% year 3, or 2-1, 2% cut year 1, 1% year 2.
Rate reduction steps down each year.
Right, on the payment anniversary. So the vet's payment increases each year, but VA limits the annual increase in the effective rate the vet pays to no more than a 1% equivalent jump each year. Prevents huge shocks.
How are the increases structured?
Can be rate-based. Equal effective rate increases, like 1% each year, or payment-based, equal or roughly equal dollar increases each year. Handbook tables 10 and 11 show examples of both.
How do lenders underwrite loans with buydowns? Do they use the lower initial payment?
No. Crucial point. Lender must qualify the borrower based on the full payment amount in the note, ignoring the temporary buydown help.
Got to afford the real payment eventually.
Exactly. But the buydown can be a compensating factor when looking at residual income or DTI ratios if they're kind of borderline.
How so?
Well, lower payments early on might help the vet manage other short-term debts. If the underwriter approves a marginal loan, partly due to the buydown, they need to write down why and keep it in the file.
What if the builder or seller funds the buydown? Are those seller concessions?
Yes. Builder-seller funds for a buydown are considered seller concessions under VA rules, subject to the limits in Chapter 8, Topic 5.
Okay. Farm residence loans. Specific group here. Who's eligible?
Vets looking to buy, build, repair, alter, or improve a farm residence they'll live in as their primary home.
Just the residents.
Right. Loan can't cover non-residential farmland beyond the home site, can't cover separate farm outbuildings, equipment, or livestock. Focus is the dwelling on the farm.
Can loan proceeds pay off existing land liens on the farm?
Yes, allowed, but only if the reasonable value of the land equals or exceeds the amount of the liens being paid off. Land value has to support it.
How's underwriting handled, especially if farm income is needed to repay the loan?
If farm income is used for repayment, lender has to carefully assess the vet's farming ability and experience. Usually follow the self-employment income procedures from Chapter 4. Detailed review.
What if the vet is new to farming?
More requirements then. Need a proposed farm operation plan, crops, acres, livestock, income expense estimates, vet statement on owning buying needed equipment, and any debt on it.
Need income expense projections?
Yes, from a VA-designated local farm appraiser or other qualified person, or maybe the lender if they have an operating credit line with the vet. based on vets plan, ability, farm condition, estimate details costs, labor, seed, fertilizer, taxes, repairs, fuel, etc.
And proof of operating funds.
Need a copy of an operating line of credit commitment or other proof they have resources for operating expenses.
What about experienced farmers continuing the same operation?
If they use a credit line for operations, lender needs 3+ years of records. Advances, payments, carryover balances. Need to analyze any buildup in operating debt.
Okay. Loans for manufactured homes classified as real estate. Important first point here.
Absolutely critical. This section is only for manufactured homes permanently affixed to a lot and legally considered real estate under state law.
Not just any manufactured home.
Right. If it's not permanently affixed or treated as personal property, that's a different process. Lenders need to call the VA number, 1-877-827-3702 for guidance on those.
What are the loan purposes and max amounts for these real estate manufactured homes?
Table 12 breaks it down. Scenario 1. Buying a home to affix to land already owned. Max loan is lesser of purchase price plus improvements plus funding fee, or VA NOV plus funding fee.
Okay. Scenario 2. Buying home and lot together.
Max is lesser of total purchase price unit lot plus improvements plus funding fee, or unit purchase price plus improvements plus balance owed on land mortgage contract plus funding fee.
Scenario 3. Cash out refi of existing loan on home plus buying the lot.
Max is lesser of existing loan balance plus lot purchase price up to reasonable value, plus necessary site prep VA determines, plus reasonable discount on refi part plus closing costs plus funding fee, or total reasonable value of unit load improvements plus funding fee. It's complex.
Wow, yeah. Scenario 4. IRRL to refi existing VA loan on perma-fixed home and lot.
Max is sum of existing VA loan balance plus allowable closing costs plus up to 2 discount points plus funding fee. And all standard IRRL rules from Chapter 6 apply too.
Okay. Last specialized loan type, loans to Native American veterans on trust lands. What's the overview?
This is a unique program where the VA directly underwrites and funds loans for eligible Native American vets building or buying homes on federal trust land, called the Native American Direct Loan Program, or NADL.
Where can people find more info on NADL?
VA website has details. benefits.va.gov, homeloansnatal.asp, that's benefits.va.gov/homeloans/natal.asp.
Okay.
And for specific questions about a property in a certain state, contact the VA Regional Loan Center covering that state.
Well, that was quite the journey through Chapter 7. A really comprehensive look at all these specialized VA loan options.
It really shows the breadth of the program, doesn't it? How it tries to adapt to different veteran needs and housing situations.
Absolutely. It really highlights the VA's commitment to supporting veterans in sometimes pretty complex home ownership scenarios.
It really does.
We really hope this deep dive has given you a much clearer picture of these more intricate parts of VA lending. Maybe a shortcut to feeling more informed.
Yeah, and it kind of makes you think, doesn't it? How the program evolved to meet these diverse needs. What other, unique circumstances might pop up in the future? What might warrant even more specialized loan types down the road?
That is a fascinating question to chew on. How will it adapt next? If you want to dig even deeper into any of these specific loans we talked about today,
definitely check out Chapter 7 of the VA Lender's Handbook itself.
Yeah, or reach out to the VA with specific questions. There's always more to learn. Thanks so much for joining us for this deep dive.